We are going to start our program today. As we all know, Kala is a social organization started in 1977 and is always interested in the public affairs, political, not only political and socio-cultural, is also interested in the well-being of everyone. So today we have the opportunity to talk about the finance matters, which is an urgent need for many of us. So therefore, let us start without much delay. And I invite Mr. John Sanjo to introduce other guests, and he will introduce himself, and the formal introduction of everyone will be done later when our officials, President and other people come to our forum. Thank you very much for coming, and please welcome Mr. John Sanjo.
We're hoping today to help you better understand, what you're entitled to under the Medicare program, to help you with some basic investing processes and understanding, and at the same time give you an overview of what you need to do to protect your family with some basic estate planning. So I'm going to ask Rose Burge, who is our specialist in handling Medicare supplemental insurance programs in our offices. And our firm is Capital Insurance and Investment Planning. I've had the good fortune of meeting George Matthews, while I was an instructor at the community college, and we've had a great opportunity to enjoy a nice relationship where he's introduced me to a great many folks that I've been able to help out. So we're hoping today that this is informative for you. We will have a question and answer session. So please, if you have questions at the end of her presentation, Rose will be able to answer those for you, and I will do my best to do the same, and so will Bob. So without further ado, we're going to start out with the Medicare presentation, and I'll turn it over to Rose Burge. Thank you.
Okay, good evening, everybody. As John said, my name is Rose Burge. I'm an insurance agent and a Medicare consultant. And I must be in the wrong place because Medicare is for people 65 and older. I think you all look too young. I don't know. So anyhow, I've been helping seniors, their families, and others try to navigate through the maze of Medicare. It's very confusing. There's a lot of parts to it. So hopefully tonight I'll be able to clarify some of the points and answer any questions that you have. Okay, what is Medicare? Is there a cost? Who is it for? When can I enroll? There's so many questions, and you probably have even more this time of year because with all the ads on TV and the radio and in the news, you're hearing all kinds of terms. Annual enrollment period, Medicare Advantage, Parts A, Parts B, Medigap, so many more. Well, I hope to clear up some of this confusion for you. Okay, first of all, what is Medicare? Medicare is a federal health insurance program for people who are 65 and older, for people under 65 with certain disabilities, and people with end-stage renal disease, which is kidney failure, that would be requiring dialysis or kidney transplant. It's regulated by CMS, the Centers for Medicare and Medicaid Services, which is a division of the Department of Health and Human Services. Okay, a little bit of history about Medicare. 52 years ago, President Lyndon Johnson enacted Medicare. Medicare and Medicaid started as basic insurance programs for Americans who didn't have health insurance. Enhancements added to the program have changed over the years to provide more and more Americans with access to quality and affordable health care they need. A little trivia question for everybody. Does anybody know who the first person to sign up for Medicare was? Okay. Harry Truman. Harry Truman, a past president, he was at the bill signing ceremony in Missouri, and President Johnson wanted to recognize him. 10 years prior, in 1945, President Truman, he had tried to propose a national health insurance bill, but Congress had opposed it. So at the bill signing, Harry Truman signed up for Medicare and was the first person to be issued a Medicare card. Okay, what is the cost? One of the big questions everybody asks. If you or your spouse have worked 40 or more quarters, which is 10 years, and contributed to Medicare taxes, then Part A is premium free for you. Part B, you will have to pay for. Part B in 2017 was $134 a month for people that were new to Medicare. Of course, there are always different premiums for higher income brackets, and also people can apply for extra help for lower income brackets. Penalties. There are also penalties associated with Medicare. So it's very important to know when to sign up, to know what plans you're signing up for, be aware of it so you aren't penalized and suffering with that for as long as you have Medicare. If you don't sign up when you're eligible, you may face a penalty. These penalties stay in effect for as long as you have Medicare. If you don't have credible drug coverage, you also may face a penalty. This doesn't mean everybody has to sign up at 65. There are special circumstances that dictate when you sign up. You can postpone it if you have health insurance through your employer. So there's many circumstances. It's important to know your options, know the enrollment periods, and be aware of that, and then you'll be fine. It could save you a lot of money. Okay, what is it all about? Medicare has 4 parts. Part A, B, C, and D. Part A covers hospital care, skilled nursing facility, nursing home care, hospice, and some health services, home health services. Be sure to know the extent of coverage for these benefits when you're considering enrolling. One hospital stay can be financially devastating to a family if you're not aware of what the benefits cover. Part B. Part B is medical insurance. It covers preventative services as well as medically necessary services. It also covers services needed to diagnose and treat your medical condition. Again, be aware of the extent of coverage that Part B provides so that you don't have yourself in a situation that you're not prepared for. You may want to consider supplemental coverage to help cover the costs that Medicare A and B does not cover. Part C, Medicare Advantage plans. These are plans offered by private insurance companies. They cover all Part A and B costs. They also cover costs such as deductibles and copays. They can cover prescription drugs, and some of them even cover some dental and vision benefits, and some of them offer other supplemental or other optional benefits like gym memberships, nurses' hotlines, different things like that. You must continue to pay your Part B premium as well as any premium the Medicare Advantage company charges in order to keep this coverage. Part D is prescription drug coverage. It's also called a PDP plan, so you've probably heard that term before. The plan's premiums and formularies differ. So it's good to know how to get your drugs and figure out which plan has the most cost-effective avenue for you to get your prescriptions, which preferred pharmacy to use. Every company, their formularies, their tiers, They're different and they change every year. It's a standalone drug plan, and you must have Part A and or Part B in order to enroll in a Part D plan. If not, you'll be faced with a lifetime penalty if you don't have credible drug coverage or if you don't get extra help. Okay, stay here. This is the Medicare roadmap. This shows you the basic route most people will take to access their Medicare benefits. As you can see, there's decisions to make. Make sure you know your options. Where do you start? For most people, turning 65 is when they would enroll in Medicare. Some people that are receiving Social Security disability benefits are automatically enrolled, and people that are receiving Social Security payments are automatically enrolled. If you're not enrolled, you would contact the Social Security office or go online and you can enroll online. Some of your choices. After you're enrolled in Medicare, you have Original Medicare, Part A and B. That does not cover prescription drugs, and you may want to have a source for that. What else does it have? It does not have a network. There's no network involved. Any doctor that accepts Medicare patients will accept Original Medicare as your health insurance plan. And you may want additional coverage because this does not cover everything. Another option is Part C, Medicare Advantage. As I said before, Medicare Advantage are insurance plans offered by private companies. These plans cover all Part A and Part B benefits. They also, usually they'll include the Part D drug benefits as well. So they're all wrapped up in one nice little package in Part C. They may have a premium in addition to your Part B premium. Usually you have to use network providers and hospitals, and these plans also have a maximum out-of-pocket annually. So if you have one of these plans, you reach your maximum out-of-pocket, then the insurance company will pay the rest. You don't have any more payments. And you may need referrals, depending on the type plan you get. Another option is Medigap plans, or Medicare supplement plans. These plans are standardized policies offered by private insurance companies. Any doctor or hospital that accepts Medicare will accept these plans. They help cover the gaps. So you've probably heard, well, they're also called Medigap. They help cover the gaps in Medicare. The plan benefits are regulated. So every company that offers Medigap plans, if they offer a Plan G or Plan N, they go by letters. And every company that offers it has to have the same benefits for that plan. They have a premium along with your Part B premium that you still have to pay to the government. They do not offer drug coverage. So you would get a standalone Part D plan with that. When are you eligible? Initially, typically most people are eligible when they turn 65. You have a 7-month initial enrollment period. That starts 3 months before your 65th birthday, includes the month of, and lasts for 3 months after. If you've been receiving Social Security disability benefits for 24 months, then you're eligible and you will be automatically enrolled. What if I miss this? In most cases, if you don't sign up when you're eligible, and then you do sign up, you will be faced with a late enrollment penalty. These penalties remain in effect for your lifetime. They don't ever go away. It's not just a year or two. They stay. So you don't miss your enrollment period. They can benefit you depending on your health care needs. So be aware of the special enrollment periods just in case you get to that point. make sure to know your options. And as I said, there are special enrollment periods. Sometimes, if you're currently working and have group coverage with your employer, that will entitle you to a special enrollment period. Based on your income, there's some, if you're low income subsidy, you get special enrollment periods. So it's important to talk to your HR department if you are still working and see whether at 65 you should sign up or wait until your group plan, your group insurance is over. Okay, and really I can't stress how important it is to know your options. It could save you a lot of money in the long run. It's important to know that. The bottom line, Medicare can be confusing. Know when to sign up. Know your needs. Compare benefits and costs. Make sure your doctors are in the network. Are your drugs covered? Do you travel? Know your options. Talk to an agent. Making the wrong move can lock you into a plan for a year or more and cost you a lot of money out of pocket that's not necessary. It can also lead to a penalty, which nobody wants that. You owe it to yourself to review your Medicare insurance plan every year. Drug plans and health plans. Every year, review it, see what plans are out there, what new plans. If it's time to make a switch, if you're good where you are, it's very important to do that. From October 15th to December 7th. That's when you would want to review your current plan and see how it worked for you in the last year. You know, are you still happy with it? Have your doctors changed? Have your prescription drugs changed? Did you move? Are you out of network? This is when you can review it, and if you want to make a change, you can make a change for an effective date of January 1st of next year. And this is every year you have this option.
I have a follow-up question.
Yes.
Medicare Part A, B, and the Medigap plans.
Yes.
Is there any point in changing the carriers?
For the Medigap plan?
Medigap plan.
You can, they don't fall under the annual enrollment period. So if you have a Medigap plan, you can apply to change that at any time. However, after your initial enrollment period, when you were guaranteed issue into that plan, after that, you will have to answer medical questions, so you may get rated based on your answers, or you may be declined. But you always have an option to apply to change companies or change plan letter.
Because we're kind of in a condensed time frame, I apologize. We are going through this rather quickly, but we will do our best to make sure all your questions are answered, and you will have full access to us in case there's a question that arises after you've heard us this evening and you wanted to contact us. Of course, we'll make sure that you get all your questions answered, and you'll know how to contact us to make sure that that information gets to you. I'd like to introduce my colleague, a gentleman who I've known for more than 30 years, and we kind of grew up in this business together, sort of. And he has been not only a good friend, but a good colleague who's helped a great many of my clients and my family as well. This is my attorney colleague, Robert Esposito. So thank you, Robert, for being here this evening, okay? I'm going to turn this over to Bob, and Bob's going to speak to you about estate planning and things that you'll need to know to help make sure that your family's well protected and that your wishes are carried out should anything arise and you pass away, to make sure that your spouse and your children and the heirs that you want get the help, the assets, and avoid paying any unnecessary costs to transfer those holdings to the next generation. So Robert, if you would.
Thank you. And now that John has told you everything that I'm going to speak about, I'm going to sit back down. Before I start, let me see a show of hands. Who here has a will? Very good. Who here has a living will? Good. Who here has a power of attorney? Okay. This is a topic that can take me many weeks to go over. So it is, by necessity, I have to make it introductory tonight. I'd love to go on about some of the intricacies and some of the really neat things that we can do in estate planning. I'll try my best, but it's a very, very involved topic, so please bear with me on that. We'll have to try to just stay with the will is the central or core document that comprises a well-planned estate to make sure that the assets and the wealth that you have worked hard for all your lives and have accumulated will be passed on to your spouse, your children, your grandchildren in a way that you decide. So when we talk about the core document, we're talking about can you switch over to the will, John?
Advantages of a will?
Yes, please. Yes. I'm going to try to stay with the script. But I'm a renegade, see. All right. When we sit down with someone and we talk about their will, essentially we ask them two questions. Number one, what do you want to happen to your estate when you pass away? And in what manner? And number two, who will you name to see to it that that plan is carried out? That person, as we'll get to shortly, is called the executor of your will. Now, why do I need a will? I see people from every age category. I see them from every walk of life. I see young couples and I see older couples. When I see younger couples, they come to me and they say, I don't know why I'm here. I don't have anything. Why do I need a will? And I'll ask them a question. Do you have children? Well, yes, I do. Are they small children? Are they minors? Yes, in fact, they are. Well, then what greater asset can there possibly be than your children? So your purpose at a younger stage of life is to see to it that when you're not here, or if something happens to mom and dad, and they are not here, that those children will be provided for in a very careful manner. Now, children cannot inherit property directly. In case you're wondering, in the state of Pennsylvania, the age of majority is 18. Now, a lot of people will say, well, yeah, okay, that's great, but my kids, you know, if they got money, it'll burn a hole in their pocket. It'll be gone by next week. Do I have to see to it that they get property at the age of 18? And the answer is no, of course not. Even though 18 is the minimum for the age of majority, you can direct in your will at what age or at what point the children would receive your estate if something were to happen to you now. There are lots of planning techniques and options available for that. When we talk about children, we will have wills that will include language to protect them. The language that's in the will is called a trust, specifically a testamentary trust. It takes its life right within the will. It's not a separate document. You may have heard discussions of living trust, and I'll touch upon those if I can, if time permits. But for our purposes right now, the children cannot hold property, and so they will be put, if anything happens, their shares of your estate will go into what we call testamentary trusts. What does that mean? It means that someone will be named by you to hold on to the funds for the benefit of the children. That person is called the trustee. There will be language in the will that instructs the trustee as to how and in what manner assets can be distributed to the children. Many times it's for health, education, their maintenance, their upbringing, all the kinds of expenses that a parent would pay if the parent was still here supporting the child. We need to also ask this question. Okay, if the money doesn't run out and your child has reached an older age, we would recommend that the assets that are in that trust now be distributed to them. Whatever's left at some point in time in the future be distributed to the kids. And again, that's a decision that you make. You could say 18, you could say when the child reaches age 18, whatever's left in the trust is to be distributed to the child. But most of the clients I see, if not all, will say, you don't know my kids. If I gave them money at the age of 18, it'd be gone by the time they're 19. So we direct in our will when the trust assets will be distributed out to the kids when they reach a certain older point in time. And the choice is yours. You could say age 18, you could say age 21, 20, any age at all. You could stagger the distribution and say, for instance, when the child reaches the age of, I'll say 21, half of the assets that are in that trust will be distributed to the child, and the kid can do whatever they want with the assets. And the other half will still continue on and be held in trust until they reach another age, for instance, maybe 24 or 25. I have seen lots of different, can you hear me? Does this work?
I think you need to hold it a little higher up because it's where this moves.
Okay. There's a lot of different ways that families can make that decision. For instance, one of the ones we see a lot is something that goes along like this. At such time as the child reaches the age of, I'm going to say for this illustration, age 27, or at such point in time when the child receives an undergraduate college degree from an accredited college, whichever occurs first, they can have the trust money. So what's going on there is that the parents are trying to give the kids a little bit of a kick from the grave, so to speak, and say to them, that's fine, you don't want to get a college education, there's nothing wrong with that decision, but you'll have to wait till some other later year. Many times kids will get their undergraduate degree well before they turn 27 for this illustration. So a lot of families will use that option as well. Okay. One of the other decisions that is very important in the advantages of a will is who you name as the executor. This is a very important decision. If I were to ask anyone here, has anyone, up till now, has anyone served as an executor in an estate? Okay. Does anyone here know what they have to do as the executor? Most of the time it's no. Okay. That's why we're here. The executor has an important job. It's referred to in the law as a fiduciary responsibility. They're holding money that's not theirs. They're holding money that belongs legally to someone else. And again, particularly in the area of care of minors, it's critically important that the choice of the executor be very carefully made. You want someone who will be trustworthy, someone who knows the needs of your family, knows the needs of your children in particular, and can handle the funds every bit as competently as you would if you were still here. What we often suggest with executors and trustees is that a backup be named, one or more backup be named. Okay, so you can have A as the executor, followed, if necessary, by B if something happens to A. You could name co-executors. You could have A and B to serve together. So there's lots of choices that can be made there, but it's an extremely important choice that you need to make. Okay. A couple other things. Where are we? Page 6. Yeah.
That's where we're at.
Okay. All right. Good. Another thing that happens in the will is the continuation of a business. It's really important that the will gives instructions to the executor as to how, and again, in what manner a business would be continued in the event of your death. We want to make sure that the assets that comprise the business are used prudently, so that, again, the asset, the business that you have worked to build over the course of your lifetime is not just going up the chimney in smoke. Okay, so we have to have that. So I covered what I think are the key decisions that need to be made for your will, And with that in mind, let me see where I want to go next. Okay. Page 7. Okay. How are we at 7?
Key planning decisions.
Key planning decisions, okay. Believe it or not, there are more than one way to transfer wealth besides a will. We call those will substitutes. A couple of examples are jointly owned property. A good many of us own our home together with our spouse jointly. Under the law, on the death of the first person, the surviving spouse just becomes the owner of the house in full. It does not go through a will, it does not pass through an estate. It is done automatically by operation of law, and it's a very important and very common example of a will substitute. There are other types of will substitutes. One is mentioned in here as number 2 and number 3 is the revocable and irrevocable trust. Now again, I wish I had more time to go into the specifics of trust planning. We can really do some really nice things with trusts. They kind of get a bad name sometimes because there are those who are out in the marketplace selling trusts to people who may not really need them. We want to make sure that before we do that kind of thing, that you need it, and that it'll accomplish a good goal, something that really has a concrete benefit, and not just buying a book full of legal documents that you really may not need. So when trusts are called for, they are great, and there's a lot of creativity that can be employed to use the trust in connection with the estate plan. But it's another example of a will substitute. If you have what I like to refer to as financial products, life insurance, for example, annuities, IRAs, individual retirement arrangements, and things like that, that have a beneficiary designation on them, those two are a very important example of a will substitute, because on the death of the account owner, there will be a designation made by that person as to who will receive the asset upon the person's death. That is a beneficiary designation, and a lot of times we have seen where estates can get into a lot of hot water if they don't do the beneficiary designation correctly. What do I mean by that? A classic example is a qualified retirement plan or an IRA. We have had instances where someone has passed away and they had this qualified plan, and they made the mistake of having the beneficiary designation their estate. In other words, what they did was they wrote down in the papers that on their death, the assets that are in that account go into their estate. Okay, can you do that? You sure can. Should you do that is a big different question. In this particular case, I'm thinking of the estate had to pay a huge amount of unnecessary income tax because the beneficiary designation was not properly done. So there are some really important decisions that are made when we talk about the designation of all financial plans, financial products. Now there's a lot of other things that we could do with them. You can have charitable bequests. I'm on page 9. I really don't know how well we can see this. So it's kind of small. Yeah. Okay. Well, I don't need that. You just need me. Okay. Anyway, the will is a good place to do charitable giving. In addition to that, there are a lot of other techniques that are available when we are talking about the federal estate tax. Now, in terms of death taxes, there are, for our purposes, 2 types of death taxes. There's the one tax that is imposed on the state level, Pennsylvania, New Jersey, New York, and so forth. And then there's one imposed on the federal level. And you hear a lot of discussion coming from politicians in Washington about the so-called federal death tax and how some want to get rid of it and some want to keep it. It is a tax that is it's an expensive tax if it applies. Now, the latest rules are that the federal estate tax does not apply unless the person's net worth is greater than $5.45 million. That number goes up each year. We call that the threshold amount, or sometimes referred to as the exemption equivalent. What that means for many of us, whether you think it's fortunate or unfortunate, is that we don't have to consider the federal estate tax if the estate we're planning is not up to that threshold number. But when it is, then again, there are some really great techniques, all legal, all well recognized in the law, to minimize the estate tax if it applies. Now, this is worth mentioning because of one very important thing. When we are calculating the federal estate tax, I sit with someone and I'll say, okay, total up in your mind what the total of your net worth is. And they'll do that. And I'll say, now, is it over $4.54 million? Oh, no, we don't, it's not that. The good news and the bad news is, the good news is it's not. The bad news is it's not too. So you don't have to worry about federal estate tax. But I'll say, well, wait a minute. Do you have life insurance? And in all due apologies to my life insurance friends, it's always a good idea to have as much life insurance as you can. And they'll say, yes, as a matter of fact, we do. How much life insurance do you have? It's, I believe, around $2 million or so. I say, when you add that to the number for your net worth, does that put you up over the threshold amount? And a lot of times, it does. There is a technique for planning that, in that instance, through the will, that could substantially reduce, if not eliminate, the federal estate tax on that life insurance. I wish I had more time to go into the specifics of it, because it's a really nice technique. Again, all this stuff is legal and recognized by the law. Moving off of the will for now, and let's look at page 10. Okay. Let me touch upon a couple of other legal documents that will form, many times, the planning that's done for a person's estate. One of them is and I mentioned trust, and I wish, again, I had more time for them, but they just know for now that a trust is a great planning technique when it applies. Besides that, we also have some other documents, one of which is the durable power of attorney. There are two types of these. The first is what I like to refer to as for financial transactions. With the durable power of attorney, the person known in Pennsylvania as the principal names a person that is referred to as the agent to handle that person's financial affairs. Everything from paying bills to anything that has to do with dollars and cents or asset management and so forth for the principal. The other type of power of attorney, which is really very important, is the healthcare power of attorney. And in that instance, the principal delegates a number of healthcare functions to the agent. For example, if I have one of these documents and I get real sick and I'm unable to understand or make decisions for my medical care, the healthcare agent under that healthcare power of attorney gets to do the job. So I'm covered, all right? So lots of times what I do in my practice is I put the two together in one document. Why should you have two when you have one? We put both there in separate sections and it works well. The other document is referred to as the living will. And sometimes that word could be a little confusing because it suggests a testamentary giving, but it's not really. A living will can be thought of as an advance directive. And it says this: if I ever become in a medically diagnosed end-stage medical condition, I'm terminally ill, and there's nothing that the doctors can do to stop it. I am on my way to die. if that happens, and I can't make decisions for myself, such as maybe accepting some new experimental drug or some treatment or therapy or so on, I will make those decisions. But if I can't, and I'm in that terminal condition, the person who I have named in the living will, which we call in Pennsylvania the surrogate, is required to withhold artificial means of life support. Think of it this way. I'm on the roller coaster and it's going down and it's never going to come back up. It's a sure thing that I'm going to die based on a reasonable degree of medical certainty. If I can't make decisions for myself, then that surrogate is required to withhold artificial means of keeping me alive. Now, for instance, if someone says to me, here, let me help you with your soup, and they help spoon feed my meal, that's natural. If they stick a tube down my throat, it's not. It's invasive, it's artificial, and under that condition, it's not to be done. The other condition is if I am in a coma. If I'm in that terminal condition, and we see this a lot, the two really could come together very frequently. If we see that the person's in a coma and they're in an end-stage medical condition, there's no hope for their recovery, then in that instance as well, the living will says artificial means are not to be utilized. Some have referred to it as death with dignity. I would say 30 or more years ago, the percentage of people who elected to have living wills was probably, and this is just an unscientific guess on my part, maybe about 10 or 20%. Since then, it's almost around 90%. When people see what happens when medical science prolongs the process of dying, they say, I don't want to be like that. I don't want to put this on my family. What's the point? If I'm going to die, why are you doing all these artificial things to me? Disconnect them, spoon feed, okay, help me with water. Oh, and by all means, administer pain relief. If I'm in pain and I'm awake, all right, we want to keep the person comfortable. So there's nothing artificial about pain relief. It's always there. Some might argue that pain relief medications can sometimes shorten the amount of time the person has left to live. Again, what's the point? If I am terminal and I'm in pain, I don't care if I die a couple months sooner. All right, give me the pain relief. And so essentially that's an introductory type of discussion of how these documents work together. So I like to call them the big three. We have the will, we have the power of attorney, and we have the living will. Sometimes we will use trust language, either within a will or in a separate document, to accomplish the person's goals and intentions. One of the big things that has come up in recent years, probably since around, I think it was 1995, when the Health Insurance Portability Act was enacted. Essentially, you may have heard the term HIPAA used. It's a federal law to protect medical records from disclosure unless the patient authorizes it. It has become something that could be really a stumbling block sometimes. You can run into need to get medical records so you could do your job as the healthcare agent, and you run up against a brick wall because the law tells the doctor, I can't disclose it. The one thing that we make sure we do with the healthcare power of attorney is we specifically grant to the agent access to my medical records. So no one's going to run into any brick walls about that. They're going to be able to get the records and, based on the information in those records, make intelligent decisions for my care. So that's another important part of the healthcare directive.
Can you please touch on the duties of the executive?
Yes, please. Page 15. Back to the wills for just a minute, and I mentioned how important it is for the executor that you choose. And again, the recommendation is not only do you choose an original person, but also a backup or alternate executor in case the first person named is unable or cannot continue doing that job. There are essentially 10 major components of these duties. Of course, the first thing that has to happen is we've got to find a will. And when a person passes away, usually it's not a problem. Someone will come forward and say, here's the will, I found it in his papers, her papers, and off we go to get the process started. Sometimes, and I actually have one of these, and you know who I'm talking about. I have a person in my office who passed away, and he did have a will, we can't find it, and now we are asking for the authorities to allow us to accept a copy of this will in lieu of the original. It doesn't happen that often, but it can happen, and if it ever does happen, it's not the end of the line. There are these possibilities of doing things like this, but mostly we'll find the will. We will take a look at the will. Now, a lot of times, it's interesting. You watch a lot of the old movies and TV shows where you have the grieving family, and they're sitting in front of the lawyer's desk, and he has the will open in front of him, and he's going to do a reading of the will. Makes for great Hollywood, but we don't really do it. Sometimes people ask us to do it, and I love it. Okay, you want me to read the will? I'm ready, so I'll read the will. But generally speaking, we don't have that level of dramatic behavior. We do let people know, of course, that there's a will and that maybe they're named in that will, and that'll all happen. But it's an interesting kind of thing. I think probably in over 40 years, I've probably read a will maybe about a dozen times, so it doesn't happen much. It doesn't happen at all, not much at all. Okay, so next, the executor's job is to take possession of the decedent's assets, of the deceased person's assets. So if there are bank accounts over here and investment accounts over here, and there's a house, and there are other items of property of all different kinds. The executor's job is to take possession and control over those assets. And why? Because there's going to be provisions in the will for how those assets are to be distributed. So the executor's job starts off by taking in all those assets. We call it marshaling the assets. The executor will also have to pay legitimate bills and debts of the deceased person that may not have been paid before they passed away, such as medical bills, balance due on things of that nature, credit card balances, funeral costs, and so forth. All those are part of the executor's job to make sure that they are paid. There also will be taxes. Can't get away from death and taxes, it seems. The executor is primarily charged with the responsibility for the death tax returns and to pay the inheritance or death tax out of the assets that are in the estate. Following that, the executor renders what we call an accounting to the heirs who are named in the will to receive the estate. That accounting is critical. It is given to them to show every penny that came into the estate, every penny that went out of the estate, an explanation for all those items, and a bottom line that remains after the payment of those expenses and taxes. That bottom line will then be distributed to the heirs and beneficiaries in the will. We render an accounting to those persons. We want them to see where their inheritance is coming from, what assets came in, what went out, and the balance that's going to be distributed to them. They are given an opportunity to challenge that accounting. If they feel as though something's wrong with the numbers, maybe they think something is too high, maybe they think an asset was not covered, there's an opportunity for the heirs to do that when they receive the accounting from the executor. After that's done, the executor actually writes out the checks, pays out the distributions to the family. And the family will give the executor a release that indicates that they received the inheritance, that they approved the accounting that was given to them. And that's the end of the line for the executor. When someone comes into the office and says, I was appointed as executor, now walk me through this, I start by telling them the end of the line first. That's what we're going to be shooting for. You want a release from the family that says you did your job right, and you don't have to worry about being sued or any claims being made for any wrongful conduct of any kind. So I tell them that's what we're going for. That's the end of the process, and everything else that comes before that gets us to that end. So the executor will get that release from the family. Essentially, I think I've covered the duties of the executor. I think I might be, unless you have pretty much covered.
Claims and wills of trust, page 25.
Okay, sure. There are certain types of wills and trusts. A basic will is one where it's pretty much what I just described. A person has named one or more family members or other persons to receive something from the estate. They appoint an executor, and pretty much that's it. It's a simple, basic will. We see them occasionally. It seems that life keeps getting more and more complicated all the time, so we're seeing less and less of basic wills as well, as a result of the complexity of life. We can have, I would like to look at number 3 on here. It's referred to as a pour-over will. A pour-over will is made up in connection with a trust. And the trust document acts just like a will. And if there are assets still in the estate, we're good. With the pour-over will, the assets that are still in a person's estate at the time of death, the will instructs that those assets be literally poured over into the trust that that person had in existence, and then we follow the language of the trust for distribution of those assets. We could get into some really neat planning with those kind of techniques. There are also references to wills that include various types of trusts in them. Again, they are intended to protect the family, and in many cases to save taxes. One of the interesting things about trusts, and we see this a lot these days, I have a husband and wife in front of me, and the husband has been in business all his life, and the wife has done charitable work and things of that nature throughout her life. He's kind of like the nuts and bolts kind of guy, you know, he believes in dollars and cents, and she has an open heart. She wants to benefit mankind, which is admirable. He knows that if she receives his estate outright, that dirty, rotten scoundrel brother of hers is going to come into the picture and try to get money from her. And she'll give it to him because she's so kind. He's looking at that and saying, I got to do something about that. I have to protect that person, my wife, in this illustration. I have to protect her from herself, as well as from people who are, you know, will want to come up to her and say, hey, how about a loan that I don't have to pay back? Okay, and oh sure, you know, that a trust is the way to do it in that instance, because now if the dirty, rotten scoundrel brother comes to him and says, look, I need some money because I just went into bankruptcy and I don't have any more money, and you have a lot of it, how about helping me out? She then turns to him and says, my hands are tied. I can't get to it. It's in a trust. My husband set up a trust for me. All right? I think he explained why. I don't know for sure. It has something to do with you, though, I think. So, sorry, can't do it. Okay. I think at this point, John, unless there's any
items that you want to discuss before they come to visit with you on page 29.
That's an interesting question that John just asked. When I get a call from someone who wants to come in and start doing estate planning, They want to know what they should bring with them to the first meeting. Now, practitioners have their own ways of doing things, and you know, each of us has our preferences on how to do it. I tell them, just come in. You don't have to bring anything on the first meeting. Just come on in. Let's get together. Let me get an idea of your family structure, of your goals, your desires, and then we'll work on getting the different types of items that I need to see. Very often we will give them what we call an estate planning questionnaire that covers their family, that covers their assets, insurance, liabilities, all that kind of thing. I ask them to prepare that as best they can, get it back to me, and then I can start working on their estates for them. I may need to see deeds to real estate. I will ask for life insurance and other types of products of that nature. But I try not to burden them at the beginning, because a lot of times you know, they're already coming into it with a bit of, you know, a little bit of concern for what's going to happen to them. So I make it easy. Come on in, and then we'll work up the details as we go. It works great. So we will then get into the types of documentation that I want to see. If they already have wills, for example, they just want to update them. Clearly, I need to see what they had before. If they had trust documents, if they had anything like the living will and the trust documents, lots of times all they really want to do is just change the name of the person who is going to manage those things. So that can happen a lot of times. So once we get to that, we will have a really good picture of what we need to do for them and get the job done successfully. So that at this point, I do think I've come to the end of that outlay, John.
So what we can do is, at that point, just share with folks how often their documents should actually be reviewed.
Very good. Yes, that's the last, I think that's the last page.
Yep.
Okay. Normally, we suggest that their documents to be reviewed at least every 3 to 5 years. It's not a bad idea to get the documents out, put them on the table, sit down, take a look, see if they still do the job. In the meantime, if any types of life events occur, such as someone got married, someone got divorced, someone had a child, someone passed away, things of that nature, the one thing that I always get is, I'll be back to see you after I hit the lottery. And I always tell them, I'll be waiting. So, so those are the kinds of things that if someone is going to travel and be out of the country, let's say, for an extended period of time, we need to make sure that we have things in place back home so that in their absence, things can continue getting done for them. So those are the kinds of things that if you experience it, give us a call. We will look at the situation that you're now presented with, and we'll see if anything needs to be done to address it so that the estate plan is always current. There's no such thing as a dumb question. The only dumb question is the one that's not asked. I make sure that before someone leaves my office with their legal documents in hand, all signed and executed, that they have 100% of their questions answered. After all, what's the point of doing this if they don't really understand what they're doing? How could it really make any sense? And again, in closing, but they will, I always assure them that as soon as they sign that document, everything they own will go to me, and that usually perks them off. But I always tell them, seriously, that you can go home and rest assured that the documents that you have the full force of the law behind them, and we're going to make darn sure that your intentions are carried out, because you're not going to be here. You have to rely on those of us here to see to it that your intentions are carried out. So that usually makes the process come to a very successful conclusion. And I think at this point, I think I'm at a conclusion.
Can I myself make a will, and it is with the witness signed and notarized? Is it valid?
A lot of people are trying to go online, go to LegalZoom, fill in the form, and print it out, you got a will, okay? I can tell you this, is it doable? It is. A lot of times I'll have someone come into my office with documents that they've gotten from online or from other locations and other sources. And my philosophy is, honestly, if it's not broken, I'm not going to fix it. But if there are problems with those documents, I will make recommendations to make sure that those problems are taken care of. So the short answer is yes, you can do that.
Okay. Another question is, nominate our own children as
And
executors.
it happens very, very frequently. We're talking, I'm assuming you're talking about adult children.
Yes.
Yeah. Lots of times in a married couple situation, we will have what we call mirror image wills, husband and wife wills. And what they'll do is they'll look exactly like each other, so there'll be a mirror image of each other. So when the first death, normally we'll see, very commonly I should say, we'll see that let's say husband dies first. His will says, I leave everything to my wife if she survives me. And if she does not survive me, then it goes to the children. Or normally they'll do it equally or whatever way they wish to do it. His will name his wife as the executor to handle the settlement of his estate. And again, the secondary executor very often falls to kids, falls to their children. So again, depending on their age and their experience, and because I'll have clients come in and I'll ask them that question. I'll say, who would you want to be the backup executor? And they'll look at each other and they'll say, well, our daughter is really good with money, but she lives in California. And our son's here, but money burns a hole in his pocket. We're not sure what we want to do. Sometimes they never come back. Not often, but they just can't decide. But the answer to the question is sure.
You talk about the estate tax.
Yes.
Your federal threshold is 5.45 million. What about the state? In the state of Pennsylvania?
It's a tax on assets that transfer from a person who died to other persons because of the person's death. In a sense, there is no threshold. It starts at $1. And the way Pennsylvania handles it is like this. They have about 4 or maybe 5 different rate categories of how much the tax rate is. If property goes to a spouse, it's a 0% tax rate. If property goes to a charity, it's a 0% tax rate. If it goes to children or grandchildren, things like that, it's a 4.5% tax rate. All this is under current law. If it goes to your brother or your sister, your siblings on a level going out like this, it's 12%. And for everyone else, it's 15%. So that's how it works. It's been like that for quite a while now, and it's not really going to change anytime soon. I don't expect that it will change anytime soon. For those of us who have the misfortune of living in the state of New Jersey, I always advise them to move out of New Jersey as soon as possible because they have one of the most onerous inheritance taxes in the country. So Florida's nice, they don't have an inheritance tax. So move out of New Jersey and move to Florida. Anyway?
Thank you.
Yes, sir.
The will we make for only the properties, assets and valuables we have in this country, or we can include the properties, assets if we have in another country?
Pennsylvania will recognize a will like that. The question was, if I have a will, obviously it's going to handle assets and things in this country, but can it also cover things held in another country? The answer is yes, it sure can. When we get into a situation like that, we have international agreements that we look at. All the countries have their own different agreements, so I can't give you a general answer. For instance, I have someone who just passed away and they lived in Tokyo, Japan. And I found out that Japan, they don't recognize wills. I was shocked to hear that. So maybe that's not right, but that's what I was told. But there are procedures that we can do to make sure that the administration of assets in other places are covered in an orderly way. It's the best I can do. Occasionally see where the husband and wife have different ideas, and to the greatest extent possible, we will make sure that whatever their plans are, we can make sure we'll make it happen.
You don't have to have 2 separate wills. It can be a joint will, right?
We used to have joint wills. A joint will would be a single document that has both the husband and wife's names in it, and it provides for the distributions of their estates in one document. It really got to the point where Pennsylvania, at least, has decided that, you know what, they caused a lot of trouble in the past with, you know, different complaints and disputes. So the better practice is to just create the two wills. So, you know, it's not going to cost anything more because I'm making the one will, but I'm only going to just copy it over to the other. So, you know, there's no extra cost like that in doing that. Let me take trustees first. Generally speaking, if a trustee is an individual, the person gets to charge what we call a trustee's commission, and it's based on a rate schedule, so that, you know, they are compensated for the job that they're doing, and it's tied to the assets, the idea being the more the assets, the more work they are doing theoretically. When we talk about a corporate trustee, such as a bank or other institutional type of trustee, the advantage of them is that they have what we call longevity, I think. There used to be a time when banks, you know, had a long lifespan, and that was the good part of it. The bad part of it is that the corporate trustees' fees are very high. So if we could get away from having to do that because of the cost factor, we'll go for that. Executors of estates are compensated in a similar manner. There are various types of rate schedules that we use. We don't rely on them strictly. We look at the nature of the assets and the type of issues that are there in the estate. Some estates are really simple to administer, and others incredibly complicated. So we take all that into consideration. And one of the things that we will do with those fees is they are reported as deductions on the inheritance tax return. And so the state is going to look at that inheritance tax return, and they're going to say, hey, wait a second, you know, these fees are way out of line. We're not going to allow them. And they'll send you a notification that the fees that you're claiming as deductions are too high in that particular circumstance. So it's a question that really comes down to individual cases. We start with a fee schedule, but we look to see just exactly how much is involved in the estate. For instance, if there's a business to run, we know that that's going to keep the estate open for a while until we have an orderly transfer of that business. So I hope that answers the question. Let's say that they are residents or legal residents of the state of Pennsylvania in the U.S. We will commence the estate proceedings here in the U.S. For the assets that are located elsewhere, we literally have to create what we call an ancillary administration in the other country. We send certain papers to that other country so that someone will be appointed there to do the kind of job that the executor has to do here. So, for instance, selling a family home or something like that, they have that authority, but it comes from their host country.
Now, the question is actually, if all the assets are in the U.S. and the person is just visiting another country or touring somewhere, or, you know,
right, I got you.
Is there any impact?
Yeah, that's a good question. Here's how it works. And I'll use Pennsylvania as my main illustration here. In the state of Pennsylvania, a resident who passes away owning any kind of what we call intangible property. What's intangible property? Cash, bank accounts, investments, things of that nature. All right. They're subject to the state's inheritance tax. If they have tangible property in the state of Pennsylvania, that too is subject to Pennsylvania's tax. What's tangible property? Well, the biggest example is real estate. Other types of examples could be jewelry, cars, things of a tangible nature. However, if the tangible assets are not in Pennsylvania, Pennsylvania cannot and does not tax them. Okay, so the only things that they will tax would be any intangible property wherever it is located, and tangible property that's located in the state. A lot of times we'll see someone who has a shore home, for example. They may have to do something about that in the shore, down the shore, but the state of Pennsylvania can't tax that property. So that's how that works. The revocable trust is one where the person who signs the document retains the power to change it or revoke it anytime, for any reason. The irrevocable, as it sounds, is the other way around. Once a person creates the document, and we place language in the document that says specifically, this trust is irrevocable and I can't take it back. All right? Why would you want to have these kinds of documents? The big reason that is put forward for trusts is the avoidance of probate. And again, I wish I could go into more of that, but I think I would have everybody fall asleep, and that would be the end of it, okay? But there is a key difference that should be mentioned. There is no tax savings for revocable trusts. All right? Because the person has retained the power over those assets, the state looks at it and says, nothing doing. You're going to pay the inheritance tax. The irrevocable trust does have tax savings. Okay. It's important that the documents be very carefully drafted. If there is a mistake in the drafting, we could inadvertently trigger tax, which of course we don't want to do. So it's very important that we make sure that we understand what these documents are going to do and what they're not.
Somebody established or got a will in New Jersey and moved to Pennsylvania as a permanent resident. Do they have to move their will as well?
Generally, no. If the will is valid when it was executed in the original state, all the other states of the country have to give full faith and credit to that document. Now, of course, we really would want to still sit down, because that could be one of these events that we want to look at to see if maybe there's a reason to update the plan. But just for relocating, no, you don't have to do anything.
But the tax rating will be according to New Jersey state.
No, the tax rate would be the state in which the person had their residence when they died. So Pennsylvania is not too bad. You know, for a lot of our families, it's a 4.5% rate. It's not too bad. Don't die in New Jersey. Move out of New Jersey. I could just see my brother coming after me now. Thank you very much for your attention. Yes.
Everyone's information. We were talking about the trust and what is the minimum? What is the minimum requirement for an individual to create a trust? Because, for example, the guy, you know, the family has a house, the family has an apartment, and the family has some savings in the bank. Are they required to create a trust? Or, you know, somebody else who has a lot of property and stuff like that? Please explain that.
Also a very good question. When someone needs a trust, we are going to do two things. Number one, we're going to create the trust, write up the document, they come in and sign it and so forth. However, there's a second very important thing that has to be done. You touched on it. You have to transfer assets into the trust. A lot of people will go home and say, okay, everything's fine, I have a trust, and then there's nothing there. They didn't transfer anything into it. So you can transfer real estate, you could transfer bank deposits, investment accounts, literally anything can be transferred into your trust. And again, it's a planning question as to what to do.
Well, we'll very, very much be looking forward to coming back and continuing to have additional presentations for you. Thank you again for asking us, okay? So what I'm going to jump into right at this time, because I know our time is short, I'll touch on the other two topics, but most people are concerned about the basics of investing. And as I share with many of my clients, investing is a science, okay? Atlantic City is one thing, investing is another. A lot of people think it's the same thing. It's not, okay? You can be that speculative, you can be that risk-driven and look for those pie-in-the-sky kind of opportunities, and sometimes they work out very well, and many times they don't work out so well. So it's better to actually have a plan and learn the basics of investing so that you have a strategy so that when markets fall out of favor, that you can still participate, not lose everything you've invested, and still make gains. Or be prepared when the markets continue, because everything's a cycle in life. And you'll see that. So we're going to go into the basics of investing, basically concentrating right now on wealth building for whatever your objectives are, for family welfare or for retirement. Okay? So Rose, if you could. So when you're trying to invest, okay, you're looking to make a purchase of an investment vehicle, or to that could be either a mutual fund, individual stock, could be a bond, etc. You're going to invest in a particular goal or a strategy. Now that strategy would be either for growth, because I want to grow those dollars or those assets, or I need it for income, okay? Each of those strategies every cause has an effect. So if it's a non-IRA, non-retirement type asset, you're going to end up having some tax treatment there. So those gains would be taxable too. Now those gains will come from income, which could be dividends, they could be interest, or they could be short or long-term capital gains. And that's called capital appreciation, okay? When you buy something for $20 a share, and 6 months later, it's increased in value to $60 a share, okay? So that would be capital appreciation. So when we're looking to invest and diversify that money, because we don't want any one concentration in the marketplace to work adversely against us. In other words, don't put all your eggs in one basket, okay? That method is called asset allocation, okay? When you put together a portfolio and you apply asset allocation, what you're going to do is take the dollars you have and spread them across an array of investments that you know move in the marketplace in different patterns, okay? For example, when stocks are up, bonds are down. And the reason for that, okay, is that stocks are a growth item, and when you buy a stock, a mutual fund, and it's a exchange traded fund, these are types of vehicles that you would invest in. Excuse me. Anything that is called an equity, okay, that would be considered stocks, exchange traded funds, okay? Those are things that you're investing in. When you buy that stock or that mutual fund or that exchange traded fund, the companies that participate in that investment, you're buying a share in that company, okay? So when you do that, what you're doing is you're taking on the risk of that company being successful or possibly not being so successful, okay? For example, if it's Starbucks, okay? You're investing in Starbucks. You're hoping that when you stop at Starbucks on the way to work, that other people are going to stop at Starbucks on the way to work as well and buy as much coffee as possible, okay? So a mutual fund is nothing more than an array of investments, either in stocks or bonds, okay? I'll talk about bonds a little bit more in just a moment. So when you buy a mutual fund, the mutual fund company has a fund manager whose job is to select the holdings for that mutual fund. Those holdings in that mutual fund will be either large companies like Procter & Gamble, Microsoft, would be IBM, or there'll be mid-sized companies, okay, we call them mid-cap. So you have your large cap companies, the IBMs of the world, excuse me, and you have your mid-sized companies, the Toll Brothers, Harley Davidson. These are companies that are a little bit smaller and have a little bit less market share. Then you'll find the small cap companies. These will be companies that when you invest in that mutual fund, those companies would be names that you would probably not, excuse me, be as familiar with. But they might be the next Microsoft. They might be the next Nike, okay? Now, they're not small per se because they're not the local storefront, but they're $250,000 in value or greater. That's what defines a small cap. So when you're investing, okay, as you come down that hierarchy of large cap to mid cap to small cap, even though you're coming down, okay, the risk is going up, okay? Small cap companies have less control over the marketplace because, again, they have a much smaller market share, they're much more concentrated, and they're much more sensitive to movement in the financial markets. So if money tightens up, the companies that are small cap companies have a tendency to have less access to that capital. So, but at the same time, when they make gains, the gains can be significantly better. But there's an imposed risk with that. Pardon me. So, in reverse, Procter & Gamble, when you go to the store and you walk down the supermarket aisle, every other product is a Procter & Gamble product. Mr. Clean, Tide, et cetera, et cetera. Their market share is pretty broad. So it takes a lot to affect that in a negative fashion. Okay? So it's safer to invest in companies that have a larger market share. There's less volatility most likely in that investment. Whereas a small company would be subject to more volatility, so there's more risk. So when you're investing, the whole idea is to spread that risk out proportionately and not take more risk than what you're comfortable with. Okay? In bonds, when we invest in bonds or build a portfolio for someone, we often put a segment of that money or a percentage of that money in bonds. Because again, when stocks are out of favor, bonds usually are in favor, and that interest dampens the volatility of the stock market. So you're getting constant distributions of interest on those bond holdings that are not really affected directly by the stock holdings of that company. When you buy the mutual fund or the stock, at that time, what you're doing is, as I said before, you're taking on the risk of that company being successful. And when you buy a bond, the difference is you don't own a part of that company, you're lending money to that company, and the intent is that eventually that money's coming, your original principal is coming back to you, okay? Because you're only giving it to them for a 5-year, 7-year, 10-year period of time, and you're expecting them to pay you interest until they pay you your money back, okay? So bonds and stocks work differently. So the purpose of combining them is to keep the ability of the portfolio to make money even when the stock market's out of favor, or if bonds are out of favor, stocks will accelerate. So since they oppose each other. As your advisor, the person who's acting on your behalf, their purpose is to make sure that the percentage that you have in each of those categories is appropriate for you, and that there are alternative investments that don't move in correlation or in the same fashion as stocks or bonds. For example, real estate. A real estate investment trust, if the market's favorable or if the market's out of favor, people still have to pay their rent to keep the roof over their head or their business. So that doesn't have the same effect as if you're buying an individual stock or an individual bond. It moves in a different fashion. So you may want to interject that into your portfolio so that that makes money, even though bonds and stocks could, for whatever reason over the course of that year, fall out of favor and not meet your your expectations. But this other investment would help keep the portfolio moving forward. So, pardon me, the role of the advisor is to make sure that the investments that you've invested in or purchased are suitable for you, and that you're not taking on more risk than you should be involved in, and that they will reach your objectives in the time horizon that you're trying to reach. That's one of the keys, is you want to be in sync with the investments growing and maturing so that the monies are there when you need them, and that they'll continue to stay in pace with the cost of living, inflation, and of course, if these are taxable investments, they have to also increase at a rate that makes it satisfactory that when you pay the tax, that you still have a profit. Okay? Now it sounds a lot very complex, and it can appear that way. There's a lot more simplicity to it, but this is basically the philosophy and the science of investing. Okay? You invest for profits, and you want the stock market actually to have variations in it. You want it to fluctuate. If you're buying a dividend generating stock or mutual fund, you want that dividend to be reinvested when it comes out every quarter or every 6 months or every year. They pay at different times. If the stock market was higher every time that you made that reinvestment, it'd be hard to make money if the stock purchase price was greater every time. So if it fluctuates a certain amount, you're going to pay a lesser price for the stock in April, and when the dividend comes out in August, you'll pay a little higher price, and then at the end of the year the stock price might go down again, and the dividend you bought shares with in the last quarter of the year bought even more shares than it did the previous quarters. You have to look at this as not a race to see how much money you accumulate, but the race to how many shares you accumulate, because the person with the most number of shares ends up winning because they end up with the most money that way. So the whole idea is to allow what they call dollar cost averaging to work in your favor by making incremental investments over the course of the year. For example, if the stock market's high for the year was April, and you put all the money in April, and the market didn't perform well the rest of the year, you really wouldn't make any money. But if over the course of the year, instead of making one investment, you made 12 investments, say $100 every month, and in January it bought you 10 shares, but that same $100 bought you 15 shares in February, it bought you 12 shares in March, and only 9 shares in April. As it goes up and down, on average over 12 months, you spent $1,200, you bought different lots of shares, you would come up with a lower average price than the highest month, but you'd pay a little bit more than the lowest month. So it's a very strong way of making money, okay? Making your money work as hard as you do. So, when you're trying to accomplish your goals and objectives in investing, the whole idea is that those investments that you make grow in value. And so that when you do redeem them, okay, or you take some yield from them, that is greater than what it was when you made the initial investment. Next slide, please. One of the things that happens is investing tends to be a very emotional thing. And it's very hard because people panic and they tend to move in the direction of what they call herd mentality, or they move with the crowd. So if markets fall out of favor, or there's some hysteric in the marketplace that causes someone to take action, and they prematurely sell, okay, and they've bought higher and they're selling lower, it's obviously going to record that loss. So the whole idea is to make sure that you're investing for the right time horizon. Don't pull your money out premature if you don't need the money for a long period of time. The markets move in cycles and trends, and that market will return. Now, obviously, 2008 was a devastating event, and a lot of people were absolutely seriously hurt from that. But the normal cycle in the stock market is going to fluctuate. And some years are going to be better than others. But the key to that is that your original purchase price, the dividends, the short and long-term gains from those investments will grow if given the appropriate period of time, and they will outpace the cost of living or inflation, okay? So taking the emotion out of investing is difficult. Sometimes that's why you use a financial advisor, because with the experience of a financial advisor, you can benefit from the fact that they're looking at it on a very, very non-biased, non-emotional basis. Next slide. So to build a better portfolio, as I had mentioned earlier, excuse me, is diversification. You want to spread those assets off among different classes. When I say different classes, you don't want to put all your money in medical technology. You don't want to put all your money in pharmaceuticals. You don't want to put all your money in energy. You want to take a little piece of everything and buy different cross-sections of the marketplace that are in favor, so that you are then experiencing the growth in the economy rather than trying to make that big, win suddenly out of one sector of the market. That concentrates your risk and makes it very, 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 very emotional when you're investing in that capacity. So the key to this is making sure, one, you're spread across enough industries and enough sectors of the marketplace that no one portion of your investments will dictate the actual direction of the entire portfolio. Okay? Next slide. Now, a 25-year-old is obviously not going to invest the same way somebody who is 60 years old is going to invest. They have different time horizons, different objectives, different goals, and a 25-year-old is going to be in the marketplace a lot longer. So they can be very aggressive. Why? One is they're going to earn a lot more money between now and the time that they're going to need additional monies for retirement, or to buy a home, or to raise a family. Okay? So that choice, they can make that money, work very aggressively, and they can afford a lot more risk than someone who has worked for 30 or 40 years, who's accumulated money, wants to protect that money, but still wants it to grow, and then wants to go into the redistribution phase of retirement and start to take income from those assets. So a young person would be an aggressive investor, someone who can then afford, knowing that they're going to go through more market cycles, take on more risk. Someone 45 years old would probably be a moderate investor. So they would have the largest percent of their investments, probably 40–50% of their portfolio, in large companies that are well known, that are pretty secure. Okay? But diversified across several industries. All right? And then a 65-year-old would be a conservative investor. The percentage that they have in equities would probably be less than the percentage the 25-year-old or the 45-year-old would have in their portfolio. Instead of having 80% in stocks, they may only have 40 or 50% of their portfolio in stocks. Why? Because they can't afford the time horizon it would take if those stocks fell out of favor to reconstruct that portfolio back to the level it was. So when you're looking to make an investment, what you want to do is you want to balance the portfolio so that it meets your time horizon and it doesn't expose you to a greater risk than you can afford at the particular time. Next slide. Staying with a schedule we call DCA. I started to talk about that before. That's called dollar cost averaging. You're putting the same dollar amount in, but are buying different shares incrementally over the course of the year to allow you to build the portfolio and not pay the highest price for the stocks or the mutual fund investments because you're taking advantage of the market fluctuations. Next slide. Rebalancing. Give you an example. As your financial advisor, I put 70% of your holdings in stocks because at your age, that was appropriate. 30% of those balance of the money was either in bonds, and a very small portion of that 30% might have been in cash, okay? Now, of that 70% that was stock, 10% of that went into small companies that are high-risk companies. Companies that we know have a good track record, even though they haven't been around forever. They have a relatively short track record, but they've been successful, and it's an aggressive portion of your portfolio. And we only allocated, of that 70%, only 5% of that investment towards that. But it was a great year. And that 5% turned into 16% of your portfolio. I have to go back, as your advisor, inform you that we need to rebalance your portfolio because you're a moderate investor today, but because you were so successful with that portion of your portfolio that you're not moderate investing anymore. You're aggressive investing. So I have to take that 16%, 15%, and pare it back down to the 5% it was, and take the other balance of that money and redistribute it in your portfolio to keep the risk the same, so that you're not taking on more risk than what's suitable for you. So you take those profits and you redistribute them back into the portfolio, proportionate to the allocation that you had previously. So that's called portfolio rebalancing. That should be done anywhere from twice a year to 4 times a year at the very most. And that'll protect your assets from shrinking due to the success you have in a particular sector that changes the risk in your portfolio. Now, obviously, previous vision is always 2020. You can always look back and you see what occurred, but you really can't always see into the future, okay? So what you do, or what we do for our clients, and what we share with our clients, is we do a lot of research. We, again, because I've been at this for many, many years, matter of fact, this is my 40th year in the business, that when you look at this, I've experienced good and bad markets, and I can see trends in the markets. I can tell when gold is priced at a certain level, and oil's at a certain level, and the dollar is valued at a certain level, and other currencies are valued at a certain level, whether or not there's stability in the marketplace. or whether or not the marketplace is on the verge of making a tremendous downturn or a tremendous upturn. So to help my clients better understand this, we're constantly doing research and reviews and updating to see if we can identify these trends so that we can posture you to make sure that your assets are protected and not exposed to, again, ordinary risk for trends that we didn't foresee or forecast coming that would affect your portfolio poorly. So you can see here that if a person took a $10,000 investment and invested that in corporate bonds in 1997, by 2016, that $10,000 investment would be worth $70,000 today, okay, in 2016. If they took the large cap stocks, excuse me, that was large cap, small cap stocks, that would be worth $70,983. That $10,000 investment would have multiplied all the way up to $70,000. But that's a lot of risk, and you can see there's a lot of volatility there. Now, the large cap would be this kind of golden kind of, brownish kind of van type vehicle illustrated here. A $10,000 investment in that portfolio would have yielded $43,000, almost $44,000. But you can tell there's a bit less volatility in that. And of course, treasury bonds, a $10,000 investment would have grown to $32,000. Thank you.
Just push the little button.
Oh, the little button. Yes, got it, okay. So, right here, the treasury bonds would have grown to $31,307. So that's triple what they were, okay? Now, obviously, you can see there's very little volatility there. So, but again, why did it make $70,000? Well, you didn't take that kind of risk. They're not designed to do that. The whole purpose of combining these assets were that we're trying to balance the risk in the portfolio so that we can make gains without overly exposing anyone to risk that they're not suited for and that they can't be comfortable with. When I say risk, if any investment keeps you up at night, it's the wrong investment, okay? If you can't sleep because you invested money in something, then obviously you shouldn't be invested there, okay? Next slide. What drives the stock prices? Well, as the economy progresses, what drives stock prices, one is company performance, innovation, technology, advancements, and one of the most important things is confidence, okay? If people feel confident in that company's abilities to produce a good product and to perform well and capture as much market share, then obviously that stock price is going to go up. If people are not confident in the company, then obviously not enough people will keep the stock if they own it or be willing to buy additional stock or buy it at all. So perception becomes reality in the stock market, and that's really important because perception can also get clouded and people misperceive things, and then they find themselves in a situation where they have either missed opportunity or they overperceived that something was going to do better than it did, and they find themselves disappointed. So the role of the financial advisor is to make sure that the investments that you have clarity and that you know exactly whether or not those investments are being perceived appropriately in the marketplace at that time. Yeah. Now, we talked about different kinds of stocks. Now, stocks pay dividends. Some stocks do not. The ones that do not are what they call capital appreciation. We're hoping that they'll go up in value on their share price. But you don't have to have the price of the stock to go up to make money. If it's dividend paying, it could pay a return that could be anywhere from 4%, even as high as 7%. And those dividend-paying stocks can provide income to help supplement your retirement, which can be extremely important to you. Now, foreign stocks, we do encourage our clients to invest in foreign holdings. Why? Because there's opportunity around the world. No one has a corner on all good ideas, and that it's often good to invest under other governments, under different currencies, and under different economies that have different inflationary rates and tax laws. And there's a lot of opportunity that can be made right now, and historically this has been the case. You'll find that most of the returns that you see outside of the US usually lag, especially in Europe, about 6 months behind us. So it's pretty easy to see a trend. If the US is doing very well, and then we know pretty much that Europe is going to do pretty well, but it's going to be a little slower and a little bit further behind us. But 6 months from now, we know those European investments might be playing a little catch up. And there might be some real opportunity to make some money under in a different currency and under a different economy. Next. Excuse me. What bonds have to offer is the continuity, okay? You're buying a bond on the basis of, you know that it's going to be an interest yield and it's going to have a declared coupon rate, and that is going to be basically paid to you monthly, quarterly, semi-annually, whichever way they distribute that interest, and that's going to help, okay? One, create additional money that you can reinvest in other holdings in your portfolio, or monies that you can live on because bonds will generate the cash flow to help supplement your retirement. Next. The different types of bonds, U.S. Treasury government bonds, usually long bonds, they're the safest because they're backed by the full faith of the current government, okay, the U.S. government. And those yields, you'll see, can be very good, but you have to hold the bond very long for it to be worth holding and to make a profit on it. Corporate bonds are different because now you're taking more risk in a corporate bond because you're hoping that the company will perform well and be able to pay the interest they promised to pay or more, and that when the bond matures, that they'll be in a position and be solvent enough to be able to pay the original amount of principal back that you invested. Municipal bonds, the big key there is you get a tax advantage. Municipal bonds, the yield on those are non-taxable to you. So what it affords you is a supplement at your retirement that would give you tax-free income to live on. So municipal bonds are a strong investment for people who are in a high tax bracket and are in retirement, who need income and want to reduce their taxes so they can stretch their money in their retirement. Okay. Cash alternatives. Cash has not been in favor for a long time. Interest rates are still very low. They will be climbing up. We'll see an interest rate change at the end of this year, and we'll probably see another one sometime in the early part of next year. But you can't live on the interest rates that are being yielded at the bank today. They're less than 2%, and they really don't afford you very much cash flow because the cost of living is higher than the yield on those interests. So if the cost of living is 4 and you're only getting 2, you're getting hurt on those interest rates, especially if it's taxable on top of that, because then the 2% really isn't even 2%. So we have alternatives that we can invest in that are short-term that often pay much better than a money market or a CD, and they're very safe because they have very short-term maturities, so you know your principal is going to come back to you within a year or 2 years at the very longest. Yeah. Now, inflation plays a big part in what investments one's going to choose and how long they're going to stay invested. You know, for example, the bags of groceries you bought last year, okay, cost a lot more money this year. And hopefully, if we can keep your investments growing, that won't affect you as much. But a $50 bag of groceries, okay, over the last 30 years now costs $108. A new car, excuse me, a $34,000 car, and that was just 20 years ago, now costs almost $74,000. So the cost of living will continue to go up. To keep your purchasing power, your investments have to keep in pace with that, or we're going to find ourselves losing that purchasing power, and the investments become basically inefficient. So when you're looking to build a portfolio, or looking to gain the assistance of an investment advisor, their role is to help you understand risk and to help mitigate that risk for you, to make sure you can make the return that you're trying to make, because we have market risk, we have economy risk, we have specific risk to a particular category, say oil, for example, okay, or currencies. Next slide. Interest rate risk. Everybody said, well, I'm going to put my money in the bank because it's safe. Well, we've all learned that banks aren't as safe as they used to be, and there used to be a lot more banks. They keep consolidating. So that does affect the interest rate risk, and the cost of living, the inflationary risk, can make interest rate risk even more severe. Credit risk, meaning that I put money in that bank and the bank went insolvent, the bank became inefficient, they didn't perform, I'm not making the money I thought I was going to make. Then we find ourselves with bonds to pay the same yield, end up eroding the principal that they're supposed to pay us back at maturity. And there's an exposure there. Next slide. So when you're comparing investment vehicles, the financial advisor, his role on your behalf is to match those investment vehicles and to make sure that your portfolio is balanced to your risk tolerance, your time horizon, when you're going to need that money, okay, and your suitability, what you're comfortable with. The role of a financial advisor is to educate you, help you better choose, okay, and make those choices, okay, correctly for yourselves and your families, and to make your money work as hard as you want it to, that allows your money to grow at the pace that you need it to grow, so that when you do need it, that the cost of living hasn't eroded your purchasing power that you've been waiting for when you're trying to target your retirement or a wealth accumulation, buy a new home, or that sure property, or that expensive luxury car that you've always wanted, something like that. But for all intents and purposes, the market's complexity has driven the need for financial assistance to across the spectrum, virtually to everyone who hasn't had an opportunity to be able to educate themselves to the risk of the market. You really need advice, you really need help, because what used to happen in a 30-day period of time can happen in seconds today. So you need advice, you need guidance, you need help, and that's what the financial advisor. So when you're choosing a financial advisor, choose someone who you have confidence in, because they've demonstrated their expertise, their knowledge, and their experience across the board. So investing is a science, as I mentioned before. Take advantage of it. It's the best way to supplement and build a retirement, build your wealth, and prepare yourself for your future financial needs. Okay? So, are there any questions I can answer at this time?
So can you briefly touch upon this Medicaid and nursing home, which is brief?
Okay. Well, let me just make George had asked us to touch on two other topics. One was Social Security, which I'm going to give you a very brief synopsis on. Social Security, you become eligible to collect Social Security starting at age 62. That's when you can trigger your Social Security. Now, the majority of people do take their Social Security at 62. Is it advisable to do so? Not necessarily so. If you have an opportunity to defer your Social Security, every year you defer it, it's going to go up 8%. And you can defer it all the way to age 70, which means your Social Security can be valued at 32% more at age 70 than it was at your required retirement date. Okay? So, for example, if I retire at 66 in 2 months, which is for my age category, the time when my Social Security retirement date becomes official. If I defer that till age 70, I will get 32% more. Over my lifetime, that could mean as much as $154,000 more in Social Security benefits that I'll receive. It's a lot of money. Now, every year you wait, it goes up, so you don't have to wait to 70. You could trigger it at 67 or 68, whatever. But if you trigger it at 62, you're going to get 28% less than you would if you waited till your full retirement age. So the decision of when to trigger Social Security is a very important decision that you shouldn't make lightly. And you do really need to speak to someone to make sure that you're triggering your Social Security efficiently and not shortchanging yourself. Because life expectancy is greater today than it was 10 years ago, and significantly greater than it was 20 years ago. The number of people living into their 90s has accelerated. So you don't want to find, because you took your Social Security early, that your purchasing power was reduced significantly in the later years when you really need that money to pay to help sustain yourself. So making a decision on Social Security is very important. In the next session we have, when we come back, we'll touch on that in a lot more detail, because there are choices that can be made in that regard. And in the terms of long-term care, we know by age 70 that 1 out of every 2 people are going to experience in a household, okay, a spouse or a husband, a situation that's going to trigger a long-term care event, where they're going to either need care in their home or care in a facility, and they're going to go to a hospital, and from that hospital, they're not going to be able to go home. They're going to need therapy. Now, under Medicare, you do get a short 100 days of combined coverage, 20 days that Medicare pays 100% for, and 80 more days that your Medicare and your Medicare gap policy or supplement policy will help pay for. But that is for skilled nursing care. Skilled nursing care says that I am in that nursing home for the same condition that I went to the hospital for, and I still need to be under a doctor's care, and I still need to be making improvement, and my health is improving, and I'll be returning to full health or a better health status. And that's skilled nursing care. And you're being attended to by a registered nurse, an LPN, or medical professional. Now, if I leave that hospital, go to the nursing home, and the reason I'm there is because I have neuropathy in my hands and I can't tie my own shoes or button my own shirt. I can't bathe myself. I can't transfer from a bed to a chair by myself without assistance. That's not skilled nursing care. That's custodial care. And that's not covered by Medicare, and that's not covered by your private insurance unless you have a long-term care policy. So the problem today, one of the biggest financial crises we're confronted with, is what's going to happen when and if, and there's most likely, more likely than if, okay, I'm going to need long-term care, help or assistance. When I was growing up, only 12, 13 blocks from here, because I lived on Friendship Street by the boulevard, and that's where I spent my childhood, in this neighborhood, going to elementary school here, etc. I would go next door to bang on my friend's door to tell him to come out to play, and his grandmother would answer the door. There were always 3 generations in the houses around me. Well, that's not necessarily the case today. The world's changed. The economy's changed, but the world's changed. One is, my parents, my father, didn't retire. He continued to work, even though he actually did retire, but he returned to work and continued to work as a consulting engineer until he was 83 years old. He died 2 years ago at 91 and was complaining terribly that he couldn't still work, that he wanted to continue to work. Okay? I'm very proud of him. He was a very successful engineer and he worked very hard. But it came to a point where he physically couldn't do all the things he wanted to do. And I actually had to admit him to a nursing home. Of course, he went kicking and screaming. He wasn't happy about it, okay? My mother was in that home already because her health had failed her, and we were forced to put her into that home due to her medical condition. His immobility, because he had 2 very bad knees and neuropathy in his hands and his feet, he had macular degeneration in his right eye and was almost blind. It was for his own safety that I put him in that home. My fear was he was a falling candidate. We were concerned about him falling, or because he had made numerous incidents where he fell, was what happens if he drops something or can't hold himself up because of the neuropathy or in his hands or his feet. Excuse me. So with that in mind, I was able to get him into a nursing facility and get him the care that he needed. Now, was it expensive? Yes, it was. And did they exhaust their funds? Yes, they did. And his argument to me was, if I would have known, okay, that my health was going to fail me like this, I would have never dreamed I would live this long. You know, I would have been better prepared for this. Well, nobody can prepare for everything, but you do your very best, okay? They did exhaust their funds, and because of that, they became Medicaid recipients, okay? Because they virtually outlived their finances. My mother was 92 when she passed just last year, okay? But I was able to use what resources we had from their holdings to take care of them for a couple of years before they ended up exhausting their funds. So we will all experience long-term care at one time or another going forward. If you don't take a hard look as you approach retirement about what the future health care cost you might incur, you might find yourself failing financially in your objectives. So that's a real big part of your planning. So when we come back the next time that you're able to allow us to make a presentation, we'll discuss that in more detail and tell you ways on how to address those needs for yourself and your family. Does that sound fair? Yes. Okay. So thank you so very much. Obviously we went way past the time we promised.
I have one question. You said you can sense the market. Is the market going to go up or down now?
I feel very strongly, my experience after all these years in the market, I feel strongly there is enough positive signs in the marketplace to keep the market going basically for the next 24 to 30 months. I feel that much confidence because people feel very strongly that the changes that are occurring, okay, they feel confident in the changes that are occurring. and that they're anticipating some serious tax changes that'll make this very, very possible. Yes?
I have one question. Roth IRA, I heard that for the earnings, no tax on Roth IRA, but any catch on Roth IRA?
There have been overtures to try to impose restrictions on the Roth IRA. They've been fought back, okay? I think the Roth IRA will be with us for quite some time. There may be some changes occurring, but if you have an existing Roth IRA, it's going to be grandfathered and won't affect you, okay, in that regard. But that is not the only vehicle that works in the same fashion. When we come back next time, I'll share with you other alternatives that can do the same thing a Roth IRA can do for you, okay?
So in a nutshell, you wanted to say that long hair insurance we should buy?
It's not an inexpensive insurance, but there are other vehicles that can give you long-term care protection or funds for care for your own care in your own home, okay, or in a facility that doesn't have to be a long-term care policy. There's other vehicles that can work to help supplement your long-term care. And again, we'll come back and give you a complete breakdown and examples of that, okay? So yes, they're not easy to buy, they're expensive, but if you're healthy and you can afford it, it's not a bad purchase. Thank you again for being such an attentive audience. I can't tell you. Great.
Wasn't it really good?
Yes.
Can you please put your hands together again? Thank you, John, Rose, and Bob. Thank you for coming on behalf of Kala and the President, Dr. Guri Mathai, and the General Secretary, Jojo Kodur, and the team. I thank you very much for your time.